Today's dish on the economic menu is a little sour. A real estate mogul's tumble from glory. So gather around the campfire as we roast some marshmallows and chat about Jay Gajavelli's fall from the peak of the pandemic-era housing boom. Our protagonist, Mr. Gajavelli, an Indian immigrant and former IT worker, became one of the hottest names in the real estate business, scooping up over $500 million worth of Sunbelt apartments with his company, Apple's Way Investment Group. Talk about a rags-to-riches story, right? He's like the Aladdin of real estate, minus the magic carpet, of course. He built his empire with the help of small investors, promising them a piece of the landlord's pie without the hassle of unclogging toilets. He presented this enticing prospect at investor conferences and on YouTube videos, sort of like a real estate rock star on a world tour. His business model was straightforward. Buy buildings, upgrade units, hike rents, and sell for a hefty profit within a few years. Sounds smooth as a glass of fine whiskey, right? Well, not quite. This business model ran into a brick wall when interest rates started to rise. Suddenly, Gajavelli's show hit a sour note, and his company, which had taken out floating interest rate loans, began struggling to keep pace with rising costs. This financial concert turned into a mosh pit, and it was not the fun kind. Imagine you're driving a car. Low interest rates are like cruising on a highway, but as soon as they start to rise, you're off-roading in a sedan. That's exactly what happened to Gajavelli's company. The Fed decided to raise the rates, and Apple's Way found itself in a Jeep with the suspension of a Ferrari. They couldn't raise rents fast enough to meet expenses, and foreclosure soon followed. This series of unfortunate events wasn't limited to Gajavelli's empire alone. Many syndicators, or as I like to call them, the Avengers of real estate, also fell under similar pressure. In the period between 2020 and 2022, real estate syndicators raised at least $115 billion from investors. But with rising interest rates, the housing market boom felt more like a balloon slowly leaking air. Congress, trying to spread financial opportunities like butter on toast in 2012, unintentionally turned the toaster on too high, allowing syndicators to market real estate investments online. This increased the reach and audience for such deals, resulting in a larger chunk of the population potentially at risk. It's like being invited to a party only to realize it's on a sinking ship. However, it's not all doom and gloom. Like a compelling novel, there's always a twist. Despite the financial turbulence, this situation presents an opportunity for seasoned investors with sturdy life rafts and good lawyers to snap up foreclosed properties at bargain prices. So keep your eyes peeled for the next chapter in this thrilling saga. It's like a soap opera, only with interest rates and apartments. Now, coming back to our protagonist, Gajavelli. His tale serves as a reminder that the flashy allure of quick riches can sometimes be as dangerous as a snake in a Lucky Charms box. And for all you budding real estate magnates out there, remember, as appealing as high returns may sound, make sure to keep a life jacket handy, because in the world of real estate, sometimes you're sailing smoothly, and sometimes you're swimming with the sharks. He took his message to his followers. I'm sick and tired of working for my money. And hey, who hasn't felt that way after a particularly grueling week at the office? Picture this. You're working as an IT professional, but the IT isn't standing for "it's terrific." It's more like intense torment. You work long hours, your boss doesn't even know your name, and you can't help but feel there must be a better way to make a living. That's when you meet Gajavelli, who introduces you to the real estate world, promising you a chance to double your money in as little as 3 years. He takes you on a bus tour around Dallas apartment buildings, showing off the properties that have already made investors wealthy. The bus tour was hosted by Brad Sumrock, a real estate investing coach who drives a Ferrari with the vanity plate Apt King. I mean, who wouldn't want a taste of that life? Investing in real estate isn't a bad idea on its own. But here's where things started to go sour. Gajavelli's business model relied heavily on rising rents and escalating property values. This approach made millions for syndicators and investors, but when the Federal Reserve began raising interest rates, the party ended. Imagine you're in a hot air balloon, floating high above the ground, the wind in your hair, the sun shining down on you. Then all of a sudden, someone starts filling your basket with rocks. Those rocks are the rising interest rates. As they weigh you down, your balloon starts to sink. The more rocks, the faster you fall until you're back on the ground. Well, in this case, the rocks caused a crash landing. In April, Gajavelli's company lost more than 3,000 apartments at 4 rental complexes taken in foreclosure, leaving many small investors facing a potential disaster. Gajavelli, our once high-flying balloonist, became one of the most significant casualties of the commercial real estate sector since the financial crisis. His company's properties fell into foreclosure due to unpaid bills, and investors lost millions. Now, this isn't a story about a single bad apple spoiling the bunch. Gajavelli was one of thousands of real estate entrepreneurs known as syndicators. Between 2020 and 2022, they collectively raised at least $115 billion from investors. Now, analysts and property investors anticipate a wave of foreclosures. It's like seeing dark clouds gather on the horizon before a storm. You know the rain is coming, but there's nothing you can do to stop it. You see, many syndicators made their fortunes by buying apartment complexes in the South and Southwest where real estate prices were lower, rents were rising, and housing regulations were generally looser. But they weren't just sipping sweet tea on the porch and watching the money roll in. They were playing a risky game, and when the stakes were raised, they couldn't cover the bet. Syndicators generally invest little of their own money, which real estate analysts say encourages excessive risk-taking at the expense of inexperienced investors. Remember, folks, always check the menu before you order. If your investment sounds too good to be true, it might leave a bad taste in your mouth. So what's the takeaway from all this? Well, if you're considering investing in real estate, it's important to do your research and understand the risks. Don't let the promise of quick riches blind you to potential pitfalls. And remember, it's easy to enjoy the ride when you're on the way up, but make sure you have a parachute for when things start to go down.